The institutional investment landscape for precious metals has shifted dramatically throughout 2025, marked by a move toward quality, transparency, and operational insulation. At the center of this transition stands Royalties Inc., the entity formerly known as Osisko Gold Royalties Limited. The formal name change, ratified during the annual and special meeting of shareholders in May 2025, was far more than a cosmetic rebranding. It signaled the completion of a multi-year strategic pivot intended to distance the corporation from the capital-intensive and high-risk activities of mine development, refocusing entirely on the high-margin, scalable nature of royalty and streaming interests. To understand the current investment thesis for Royalties, one must first appreciate the legacy of the Osisko name, which is synonymous with the revitalization of the Canadian mining sector, specifically through the discovery and development of the Canadian Malartic mine. The creation of Royalties as a spin-out in 2014, following the acquisition of Osisko Mining Corp by Agnico Eagle and Yamana Gold for $4.1 billion, established a foundational asset that remains the world's most valuable gold royalty. By late 2025, Royalties has successfully navigated the complexities of being an intermediate player in a sector dominated by giants. The company's portfolio has expanded from a single producing asset at its inception to over 195 royalties, streams, and precious metal offtakes, including 21 producing assets as of mid-2025. This expansion has been managed with a rigorous focus on jurisdictional quality, with approximately 80% of the company's net asset value concentrated in Tier 1 regions such as Canada, the United States, and Australia. This concentration is a deliberate defensive posture against the rising geopolitical volatility that has plagued the mining industry in other parts of the world, where royalty disputes and expropriation threats have become increasingly common. The transition to the name Royalties Inc. coincides with the company reaching its most robust financial state in its history, achieving a debt-free status and record-breaking cash flow generation that is currently being redistributed to shareholders through a disciplined dividend and share repurchase program.
The royalty and streaming business model in an era of persistent inflation. The core appeal of the royalty and streaming business model, and specifically Royalties' execution of it, lies in its immunity to the inflationary pressures that have severely eroded the margins of traditional mining operators in 2025. While mining companies must contend with rising costs for labor, energy, cyanide, and heavy equipment, factors that have pushed all-in sustaining costs for some majors up by 13 to 20%, Royalties maintains a near-fixed cost structure. In a royalty arrangement, the company receives a percentage of gross revenue or net smelter returns without any obligation to contribute to operating or capital expenditures. This results in an industry-leading cash margin that has consistently hovered around 97% for Royalties throughout the 2024 and 2025 fiscal periods. This high-margin profile creates a unique financial leverage. As the price of gold surged toward $4,300 per ounce in late 2025, almost every incremental dollar of revenue generated by the rising commodity price flowed directly to the company's bottom line. For a traditional miner, a portion of that price increase is inevitably consumed by higher fuel costs or wage demands, but for Royalties, the benefit is pure. Furthermore, the royalty model provides free exploration upside. When an operator like Agnico Eagle invests $40 million in a 216,000-meter drilling program at Odyssey to convert resources to reserves, Royalties benefits from the resulting mine life extension and production growth without spending a single dollar on the exploration campaign. This combination of downside protection through cost insulation and uncapped upside through commodity prices and exploration success positions Royalties as a superior vehicle for precious metals exposure in a volatile macroeconomic climate. Financial performance, and record-breaking cash generation. The financial results reported by Royalties throughout 2024 and the first 3 quarters of 2025 have consistently surpassed analyst expectations, reflecting both the strength of the asset base and the favorable commodity price environment. In the full year of 2024, the company set new annual records with revenues from royalties and streams reaching $191.2 million and operating cash flows totaling $159.9 million. This performance allowed for the net repayment of $49.7 million under the revolving credit facility, a move that initiated the company's aggressive deleveraging phase. Management's focus on the balance sheet was a response to the higher interest rate environment, aiming to eliminate debt and maximize the company's dry powder for future acquisitions.
The momentum accelerated into 2025, which Jason Atev, President and CEO, described as a good start and a solid base for the company's ambitious 5-year outlook. In the first quarter of 2025, despite a slight year-over-year decrease in gold equivalent ounces earned due to timing of deliveries, revenue rose 22% to $54.9 million, driven by higher realized gold prices. By the second quarter, the results were even more pronounced, with revenues reaching $60.4 million and cash flows from operating activities jumping 34% to $51.4 million. A pivotal moment arrived in the third quarter of 2025, when the company reported revenues of $71.6 million, a 71% surge, and finally achieved its long-sought debt-free status. The company ended the quarter in a net cash position, providing it with immense flexibility to pursue accretive growth opportunities without needing to issue dilutive equity or take on expensive debt. This financial strength has translated directly into enhanced shareholder returns. The quarterly dividend was increased by 20% in early 2025 to $0.055 per share, reflecting the stability and growth of the underlying cash flows. Additionally, the company has actively utilized its normal course issuer bid to repurchase shares, signaling management's belief that the stock remains undervalued and the intrinsic value of its asset portfolio. With a cash balance of approximately $49.6 million and an expanded revolving credit facility of $650 million available as of mid-2025, OR Royalties is currently liquid, debt-free, and ready to buy, positioning it as a predatory acquirer in a market where smaller royalty companies may be struggling to find capital. Cornerstone asset depth, the Canadian Malartic Complex and Odyssey transition. Any serious analysis of OR Royalties must center on the Canadian Malartic Complex in Quebec, which remains the company's flagship interest and the anchor of its valuation. OR Royalties holds a 3 to 5% net smelter return, or NSR, royalty on this asset, which is widely recognized as the most valuable gold royalty in the world. The mine, operated by Agnico Eagle Mines Limited, is currently undergoing a massive transition from the original open-pit operation to the Odyssey Underground project, which is set to become one of Canada's largest underground gold mines. This transition is critical for the long-term cash flow profile of OR Royalties, as it extends the mine life through at least 2039 and potentially much longer given the vast mineral resource base that has yet to be converted into reserves.
In 2024, the Canadian Malartic Complex was the largest contributor to the company's gold equivalent ounce (GEO) production, and this trend has continued into 2025. The underground development is progressing rapidly, with first production from the Odyssey operations having been achieved in early 2023. Agnico Eagle has invested heavily in the project, approving a $200 million de-risking program and planning for shaft sinking and ramp excavation to accelerate in late 2025. For OR Royalties, the free exploration upside at Malartic is profound. Recent drilling at the East Gouldie Zone and the Odyssey North deposits has identified significant new mineralization that could support a second shaft and a further expansion of production capacity. Because the existing processing facility at Malartic has a nominal capacity of 60,000 tons per day, there is significant latent infrastructure that could be utilized to process higher-grade underground ore, which would further enhance the royalty payments to OR Royalties in the coming decade. The jurisdictional stability of Quebec adds another layer of security to this cornerstone asset. Quebec is consistently ranked as one of the top mining jurisdictions globally due to its transparent legal framework, supportive government policies, and access to low-cost, low-carbon hydroelectric power. This ensures that the cash flows from Canadian Malartic are subject to minimal geopolitical or social risk, a factor that contributes to the valuation premium OR Royalties commands in the market. As Odyssey ramps up and the higher-grade ore begins to make a larger contribution to the production mix, Canadian Malartic will continue to provide the foundational liquidity that OR Royalties uses to fund its dividend and its broader acquisition strategy. Growth catalysts and the path to 125,000 ounces. While Canadian Malartic provides the base, the growth narrative for OR Royalties is driven by a series of high-quality development and expansion projects that are slated to reach fruition between 2025 and 2029. The company has provided a 5-year outlook that targets a 40% increase in GEO production, moving from roughly 81,000 ounces in 2024 to a range of 110,000 to 125,000 ounces by 2029. This growth is not speculative. It is based on assets that are already in construction or late-stage development by established, well-capitalized operators. A primary growth driver is the Windfall project in Quebec, where OR Royalties holds a 2 to 3% NSR royalty.
Following Goldfields Limited's acquisition of Osisko Mining to take 100% ownership of Windfall, the project has received a significant boost in technical and financial support. Windfall is expected to be a top 10 gold mine globally by head grade, with a targeted annual production of 300,000 ounces at an all-in sustaining cost of $758 per ounce.
Throughout 2025, Goldfields has been focused on environmental permitting and indigenous engagement, with final permits expected by year-end, paving the way for full-scale construction. For OR Royalties, Windfall represents a near-term transition from a development asset to a major cash flow contributor. The Namdini mine in Ghana, operated by Cardinal Namdini Mining Limited, represents another significant milestone. OR Royalties received its first royalty payments from Namdini in the second half of 2025, marking the successful ramp-up of this large-scale open-pit project. Additionally, the Island Gold expansion in Ontario, managed by Alamos Gold, is expected to drive higher production volumes starting in 2026 as the Phase 3+ expansion reaches its full capacity. Other meaningful contributions are expected from the Mantos Blancos copper mine in Chile, which is currently operating at its Phase 1 throughput of 20,000 tons per day, and the Gibraltar Silver Stream in British Columbia, where OR Royalties recently increased its interest to 100% of attributable silver. This diversified pipeline of catalysts across different metals and regions ensures that OR Royalties has a sustained growth trajectory that is not dependent on any single project's success. Strategic relationship and synergy with Osisko Development Corp. A unique and often misunderstood aspect of the OR Royalties investment thesis is its relationship with Osisko Development Corp. (ODV), which was spun out in 2020 to focus on mine development, while OR Royalties remained a pure-play royalty company. This structure allowed OR Royalties to benefit from the development expertise of the Osisko team without carrying the massive capital expenditures and operational liabilities of mining onto its own balance sheet. OR Royalties retains significant royalties on ODV's core projects, including the Caribou Gold Project in British Columbia and the Tintic Project in Utah. In 2025, Osisko Development has made considerable strides in de-risking these assets, which directly enhances the future value of OR Royalties' interests. ODV secured a US $450 million financing facility from Appian Capital Advisory, specifically for the development and construction of the Caribou Gold Project. A feasibility study released in April 2025 for Caribou envisions a 10-year mine life producing approximately 1.89 million ounces of gold, with robust economics even at conservative gold prices. Extensive infill drilling and pre-construction works throughout the summer and fall of 2025 have confirmed the high-grade nature of the Cow and Loahi zones, with results often exceeding the grades modeled in the feasibility study. For OR Royalties, the maturation of Osisko Development represents a free growth option. As ODV moves toward commercial production at Caribou and continues to explore the high-grade potential of the Tintic district, OR Royalties will see its GEO production increase without the need for further capital injections. While smaller operators like ODV face greater execution risk than majors, the significant funding secured in 2025 and the involvement of sophisticated investors like Appian have greatly mitigated the counterparty risk for OR Royalties. This incubator model, where the royalty company maintains a close but financially distinct relationship with a developer, has provided OR Royalties with unique access to high-quality projects that might otherwise be unavailable in the competitive broader market. Macroeconomic analysis: the resilience of royalties at $4,300 gold. The macro environment for precious metals in late 2025 is arguably the most favorable in recent history for royalty companies. Gold prices surged beyond the $4,300 per ounce threshold, driven by a weakening US dollar, persistent inflationary pressures, and a flight to safety among both retail and institutional investors. Central bank demand has been a particularly potent driver, with global central banks forecast to purchase 900 tons of gold in 2025 as part of a broader de-dollarization trend. Silver has also performed remarkably well, hitting all-time highs above $54 per ounce, benefiting from both its monetary appeal and its critical role in the green energy transition. In this environment, the operational leverage of OR Royalties is at its peak. Traditional miners are seeing their profit margins squeezed by the rising costs of labor and consumables, with companies like Barrick and Newmont missing early 2025 earnings estimates due to cost overruns. In contrast, OR Royalties' near 100% cash margin allows it to capture the full magnitude of the commodity price rally.
This is reflected in the company's financial results. Despite a slight decrease in ounces earned in some quarters due to project timing, revenue and cash flow have surged because the price realized per ounce has increased so dramatically.
Furthermore, the 2025 gold rally has occurred alongside a period of significant geopolitical uncertainty, including trade wars, tariff escalations, and regional conflicts. This has led to a re-rating of companies with assets in stable jurisdictions. OR Royalties, with its 80% exposure to Tier 1 jurisdictions, has become a preferred destination for capital looking to exit riskier emerging market mining investments. The current macroeconomic landscape suggests that gold may continue its ascent toward $4,800 or even $5,000 by late 2026, a scenario that would likely lead to further multiple expansion for OR Royalties as its record cash flows continue to compound. Comparative analysis: OR Royalties versus the Big Three. Within the royalty sector, OR Royalties is positioned as the leading intermediate player, offering a more aggressive growth profile and a lower valuation multiple than the Big Three of Franco-Nevada, Wheaton Precious Metals, and Royal Gold. While Franco-Nevada remains the industry's largest and most diversified company, with over 220 mining assets and a significant energy portfolio, its sheer size makes it difficult to achieve the same level of percentage growth that OR Royalties can deliver. Wheaton Precious Metals offers high-quality exposure to silver streaming, typically trades at a significant premium to its net asset value, reflecting its elite status. Royal Gold is perhaps the closest peer to OR Royalties in terms of jurisdictional focus, with roughly 60% of its revenue coming from Canada, the USA, and Australia. However, OR Royalties distinguishes itself by having an even higher concentration in these premium regions, 80%, and a more robust near-term organic growth pipeline. In 2024 and early 2025, OR Golds, reflecting the market's enthusiasm for OR's growth catalysts like Windfall and Island Gold. Yet, as the company achieves its debt-free status and continues to increase its dividend, it is increasingly being compared to the majors on equal footing. Analyst coverage in late 2025 highlights OR Royalties' unique sweet spot in the sector. It is large enough to be highly liquid and accessible to institutional investors, with a market capitalization exceeding $6.7 billion, but small enough that new discoveries at Canadian Malartic or the commissioning of Windfall can still move the needle on its share price. While companies like Sandstorm Gold offer even more aggressive growth, they also carry higher jurisdictional and single-asset risks, whereas OR Royalties' cornerstone asset at Canadian Malartic provides a level of downside protection that is unique among mid-tier firms. This balanced profile has led to a consensus moderate buy or buy rating from most Wall Street and Bay Street analysts, with price targets suggesting continued outperformance relative to the broader gold mining index. Risk assessment: counterparty vulnerabilities and asset concentration. Despite the overwhelmingly positive outlook, an exhaustive investment analysis must address the inherent risks in the OR Royalties portfolio. The most notable risk is single asset concentration. The Canadian Malartic NSR royalty accounts for approximately 37.5% of the company's cash flow. While this asset is world-class and operated by a top-tier major in Agnico Eagle, any unforeseen technical issues at the Odyssey underground transition or regulatory changes in Quebec could have a disproportionate impact on OR Royalties' valuation. The company is actively mitigating this risk through its growth pipeline, which is intended to diversify the revenue base as Windfall and Namdini come online. Counterparty risk is another critical factor. Unlike a mining company that can change its mine plan, a royalty company is a passive observer of its partners' decisions. The receivership of the Eagle Gold Mine in late 2024 and early 2025 serves as a cautionary tale. Despite the high-quality nature of the royalty, the operational failure of the operator led OR Royalties to withdraw Eagle Gold from its 5-year production guidance. Similarly, the ramp-up at the Mantos Blancos mine in Chile has been slower than previously anticipated due to throughput challenges, demonstrating that even established operators can face technical hurdles. Geopolitical risks, while minimized by the Tier 1 focus, are never zero. Even in stable jurisdictions like Canada and the United States, changes in tax law, environmental regulations, or mining codes can impact the profitability of partner mines and the resulting royalty payments. Furthermore, the company's exposure to copper and other base metals through assets like CSA Mine and Mantos Blancos introduces a degree of sensitivity to the broader industrial economic cycle, which may not always move in tandem with the gold price. Management addresses these risks through a highly disciplined acquisition framework that prioritizes assets with high margins, long lives, and proven operators, but investors must remain cognizant of the passive nature of the royalty business model. Valuation benchmarking and price target analysis. In the current high gold price environment, traditional valuation metrics like price to earnings often look elevated,
but they must be interpreted in the context of the royalty sector's unique capital intensity. As of December 2025, OR Royalties trades at a normalized PE of approximately 47.8 and a price-to-book (PB) ratio of 4.78. While these figures might seem high for a standard industrial stock, they are in line with the high-margin, debt-free royalty model, where every dollar of revenue has an extremely high conversion to free cash flow. A more revealing metric for the sector is price-to-net asset value, P to NAV. Late 2025 analyst reports suggest that OR Royalties is trading at approximately 20.9% below its estimated fair value when calculated using different valuation models, including multiple discounted cash flow (DCF) scenarios. This discount is largely attributed to the market not yet fully pricing in the growth from Windfall and the Island Gold expansion, which are set to become major contributors in the 2026 to 2029 period. The analyst consensus target price of approximately 62 Canadian dollars represents a potential upside of over 24% from current levels, providing a margin of safety.
When benchmarked against the broader metals and mining industry average PE of 22.1, OR Royalties clearly trades at a quality premium, which is justified by its 97% cash margins and its insulation from operating risk. As the company continues to execute its 5-year outlook, and as the gold price stabilizes at these new, higher levels, it is likely that its valuation multiples will expand further, potentially converging with those of the Big Three as it sheds its intermediate discount. The strategic importance of the Tier 1 jurisdiction focus. The decision by OR Royalties management to focus almost exclusively on Tier 1 jurisdictions has proven to be a masterstroke in 2025. As geopolitical tensions have risen and traditional mining regions in Africa and Latin America have become more unpredictable, the relative value of assets in Quebec, Ontario, and British Columbia has skyrocketed. Approximately 80% of OR Royalties' net asset value is located in Canada, the US, and Australia, providing a level of jurisdictional safety that is increasingly rare in the mining sector. This focus on premium jurisdictions is not just about avoiding worst-case scenarios like nationalization. It is also about the day-to-day predictability of operations. In Canada, for example, the rule of law is absolute, and mining companies have clear, well-defined paths for permitting and community consultation. This reduces the risk of long, unexplained delays that can destroy the net present value of a development project. For OR Royalties, this predictability means that its 5-year growth guidance is based on much more stable assumptions than those of companies with projects in more volatile regions.
Conclusion, synthesis, and final investment outlook. OR Royalties Inc. has emerged in late 2025 as the premier mid-tier investment vehicle in the precious metal sector. The company's transformation from Osisko Gold Royalties to OR Royalties Inc. reflects its status as a mature, debt-free, and high-margin cash flow engine that is uniquely positioned to benefit from the current macroeconomic perfect storm of high inflation and record-high gold prices. The cornerstone interest in the Canadian Malartic complex provides a level of security and scale that is virtually unmatched in the royalty space, while the underground transition to the Odyssey project ensures that this cash flow will be sustained for decades to come. The growth profile of the company is equally compelling, with a 40% increase in annual GEO production forecast by 2029. This growth is anchored by high-grade, low-cost assets like Windfall and Island Gold, which are being advanced by top-tier operators with the financial strength to navigate the current high-cost environment. The company's 97% cash margin remains its ultimate competitive advantage, allowing it to capture the full benefit of $4,300 gold while traditional miners struggle with margin compression. With a debt-free balance sheet, a growing dividend, and a heavy concentration in Tier 1 jurisdictions, OR Royalties Inc. offers a combination of defensive resilience and aggressive upside potential. While operational risks at individual mines like Eagle Gold serve as a reminder of the passive nature of the business, the company's extreme diversification across 195 assets provides a significant margin of safety. For investors looking to capitalize on the structural re-rating of the precious metal sector, OR Royalties Inc. represents a high-quality and scalable choice that is well-positioned for continued performance through 2026 and beyond.